Welcome to Richard Suttmeyer's 4 and 4. 4 blips on my radar screen, presented in 4 minutes or less. My first blip reviews the status of the bear market for U.S. equities that was confirmed by Dow Theory the day before Thanksgiving. A year ago, we experienced the Shanghai surprise where the Chinese stock market dropped more than 9% in one day, just as February 2007 was ending. I was looking for the U.S. equity markets to shift from bull to bear in 2007 and viewed this sharp break, which lasted into mid-March, as the first warning. The second break came with the subprime contagion and credit crunch, which followed a peak above 14K for the Dow in July, and this swoon lasted into mid-August. This stage ended with the FOMC cutting the discount rate by 50 basis points on August 17. The major averages, the Dow S&P 500, went to new highs in October without the participation from the transports and small caps. Since then, all averages have had patterns of lower highs and lower lows, confirmed by the Dow Theory sell signal. My second blip follows my warnings for the home builders and financials, which led the bear market. I warned about the home builders in mid-2005, and they peaked in July 2005. I first warned about financials in April 2006. The community banks peaked at the end of 2006. Regional banks peaked a year ago at the end of February 2007. I call 2007 the year of problem discovery. So far, 2008 is the year of denial, as regulators tell us that the finance industry is well capitalized and that the U.S. economy will skirt recession, and that an economic turnaround will occur in the second half of 2008. I strongly disagree. Next year, with a new president, it will be the year of realization that a long-term bailout plan will be required to help borrowers, lenders, investment banks, and mortgage-backed security investors. 6 years of monetary policy blunders, 2001 to 2007, caused the problems, and it will take years to repair the damages. Today's testimony by Fed Chief Bernanke will confirm the regulator's denial. My third blip reviews key points from the FDIC quarterly banking profile for Q4 2007, released yesterday. Fourth quarter net income was just $5.8 billion, down 80% sequentially, the lowest quarterly result since the fourth quarter of 1991. I predicted a decline exceeding 50%. For the full year 2007, net income dropped 27.4% to $105 billion. Exposures to troubling loan categories continued to grow. Commercial loans up 7.1% year over year to $968 billion. Construction and development loans up 11.3% year over year to $629 billion. Home equity loans up 8.6% year over year to $670 billion. Reserve for losses were up 31.2% to $102 billion. Loans 30 to 89 days past due grew 55.1% to $111 billion, and non-current loans ballooned 91.5% to $110 billion. My fourth blip profiles the daily chart for the regional banking index, BKX, which should soon top out. The surprise 75 basis point rate cut on January 22nd set a tradable bottom at 74.84. This, plus the additional 50 basis point rate cut on January 30th to a 3% federal funds rate, fueled a rebound to 96.49 into February 1st. A close below the 50-day simple moving average at 87.27 is the first warning that financials are vulnerable again. Send your comments and questions to support@rightsideadvisors.com. That's today's 4 and 4. Enjoy your day.